After reporting quarterly financial results last week, Amazon's share price fell by more than 4%. Some investors were curious why Amazon's stock price fell. I'll answer that question. I'll highlight the specific things that Amazon said in their recent quarterly earnings conference call that led the stock price to fall. I'll also go into more detail on whether or not that stock price decrease was justified or if it was an overreaction from the market, and if investors should view that as an opportunity or if they should view that as a reason to sell and stay away from Amazon stock. So let's get into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right. So one of the numbers that sent Amazon's stock price lower in the earnings call was this right here. Amazon said that capital expenditures were $26.3 billion in the fourth quarter. And here's the key part. We think that will be reasonably representative of our 2025 capital investment rate. In other words, annualizing that number will be approximately what we will spend in 2025. So 26 billion, 26.3 billion times 4, or roughly $105 billion they will spend on capital expenditures in 2025. The sheer magnitude of that number spooked investors, and it caused investors to sell Amazon stock. So they go on to say that just like in 2024, the majority of the spending will be to support the growing need of our tech infrastructure, primarily related to AWS, including support demand for our AI services. AI services. This is what companies like Amazon, Microsoft, Meta Platforms, Alphabet, they all increased their capital expenditure budgets significantly for artificial intelligence in 2025. And the market reaction to these investments were almost unanimously disappointed. The market was looking for a lower number in capital expenditures from all four of these companies, from all of the major tech companies that are spending on AI. The market wants companies like Amazon and Microsoft and Alphabet and Meta Platforms to take it easier on these investments, right? Don't go so much so quickly. Don't increase your investments by so much so quickly. All of these companies are raising their capital expenditures anywhere between 30 and 60% year over year. And these are large numbers to begin with, right? 50, 60, 70, 80 billion dollars. And then growing those numbers by 30, 40, 50, 60%. And so it's spooking some investors. But what investors need to keep in mind is that the companies like Amazon have been really good at allocating capital. They know what they're doing with their money. They're not wasteful. And so when they find opportunities like this to invest in their business, investors should be reasonably excited about that trend. So as an investor, when you're evaluating a company that's spending a lot of money in the business and they're telling you that they're going to do this new thing or they're investing in existing things to add more to grow the business, the first thing you want to look at is a business's history in generating profits from those capital investments. And one way you can do that is look at the company's return on invested capital. And if we look at this number for Amazon over the last decade, they've done a great job increasing this number. Now, if you exclude this decrease as a result of pandemic-era spending and the economic reopening factors, you can see that the trend line is moving higher as Amazon is getting better and better investing capital. 20% return on invested capital is a pretty good number for a company that's spending $100 billion. Now, you can have higher returns on invested capital on a smaller scale. It's easier to do. But when you're on a scale of Amazon, it's hard to deliver much higher returns on invested capital. But Amazon is doing a great job of that, and they're increasing the percentage here. Another thing you want to compare this to is the weighted average cost of capital, which when I calculated my discounted cash flow model for Amazon stock, I computed their weighted average cost of capital as 11.11%, you see here. So their return on invested capital of 20% is comfortably above the weighted average cost of capital of 10%. And to explain this very complex topic in a simple way, weighted average cost of capital is how much it cost Amazon for this money, for this capital, and the return on invested capital is what they earn on that capital. So it's like they're paying 10% for the capital, 11% for the capital, and they're earning 20% on the capital. So every dollar they invest, they're earning roughly 9% for investors, the difference between the ROIC and the weighted average cost of capital. So they are generating shareholder returns, shareholder value by putting more capital at work. All right. The second thing that sent the stock price lower was the forecast. Amazon said that net sales are expected to be 151 to 155 billion, and that represents about 7 to 9% growth. But there's a couple of things here that are making the forecast look worse than it is. So one thing is foreign exchange rates, which are volatile and swing one way or another, have swung against Amazon in the recent quarter, in the recent year, as the dollar has strengthened. That's going to cost Amazon about $2.1 billion. Another thing is that Amazon is comparing this year with last year when they had an extra day last year. So, of course, if you have an extra day last year, it's hard to beat that result this year. Amazon's going to beat that result, but it's still last year, the sales were $1.5 billion higher because they had an extra day. So, excluding those two things, that's about $3.6 billion. In other words, that would add about 2% to the company's forecast for revenue in the upcoming quarter, which would make it look a little bit better, but still a not exciting growth rate forecasted for Amazon in the upcoming quarter. So those are the two big reasons why Amazon stock fell following the earnings release. Now, was this justified? Is this an opportunity? I would say the answer to both of those questions is yes. It was justified for the stock price to fall given these metrics. Amazon increasing its capital expenditures by the amount that it did makes the business riskier. And when you have a riskier business, that should reflect itself in a lower price. All else being equal, investors want a business with lower risk. If Amazon is increasing their capital expenditure budget by 30%, which results in a $30 billion increase, there's a bigger chance those investments are not going to deliver as high a return on invested capital because the magnitude of the increase is higher, the degree of difficulty is larger, and so it's riskier, and understandably, investors pull back a little bit because of that risk. However, I also see that as an opportunity. Amazon has proven itself over and over at being effective at allocating capital. If there is an area where you want to take risk that's going to be compensated, it's that area there in Amazon's ability to invest in the business in areas that are going to generate profit and cash flow expansion. And given their history, given their success, you can be reasonably confident that this investment is going to be successful. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.